Today, we're going to talk about one of the biggest AI investors on Wall Street, Brad Gerstner, founder and CEO of Altimeter Capital, and why he believes these AI stocks still have massive upside from here. In a recent CNBC halftime report interview, Brad Gerstner talked about everything from the AI boom, Nvidia's explosive earnings, the flood of mega IPOs coming to the market, and why he believes demand for AI infrastructure is still unrelenting. He also explained why companies connected to data, tokens, and AI infrastructure could continue seeing massive long-term growth. First, I'll show you the clip of Brad Gerstner on CNBC, and right after that, I'll give you my own reaction and breakdown of what he said. Then we'll dive into 3 top AI stocks that could be strong long-term investments as the AI revolution continues to grow. Let's hear what Brad Gerstner had to say.
Let's talk some stocks, because when you were last on, we talked Snowflake. We knew the earnings were coming. You had said you were still a huge holder of it personally, but no longer in your public fund. My goodness,
Yes.
What's your reaction to this? All you can do is chuckle when you look at moves like this. What's going through your mind when you see that?
First and foremost, when I was on your show, I think you remember that I said, Scott, I think it was about 2 weeks ago, I said the data infrastructure companies like Snowflake, Databricks, and ClickHouse, they're all in the token flow. What do I mean by that? As more tokens are consumed, it accelerates their core data business. I suggested I thought they would have a great quarter, and wow, they had a blockbuster quarter. Hats off to the team at Snowflake and to Sridhar for doing this. This is a very different story than software apps like, for example, Salesforce, that more directly compete with the AI model companies. But if you peel back the covers on what they reported, 33% growth, accelerating growth versus consensus of 27% growth. They took up their full year guide by more than their Q1 beat. And the massive beat really came from these 2 trends. AI is accelerating their core, more tokens, more faster growth in their core. And number 2, their products like Snowflake Intelligence and Cortex Code hit a critical mass in Q1. So I expect this growth to continue. We're seeing it as well in other companies that we own, like Databricks and ClickHouse. But Snowflake continues to be a very, very large personal holding for me. We moved out of it in the fund, Scott, because I'm in the business. I have to manage this stuff. Year to date, Snowflake is up 10%, even including today's moves. Compare that what we moved the money into, like Micron, which is up 200% year to date, or ARM, which is up 200% year to date. So for our investors, for our shareholders, that was the right thing for us to do, even though today is an absolute spectacular, well-deserved blockbuster day for Snowflake.
So a couple things. So you're not taking any profits, for example, in the Micron, given the crazy move that we've even seen since we last spoke, just as you said 2 weeks ago. Let me deal with that first, and I have another question about Snow and Databricks.
Right. Yeah. So yes, we are actively managing our portfolio, Scott. I can't give you every tick and trade, but I will say with these parabolic moves, we absolutely are making sure that we're taking down some of our exposure in names that exceed our price targets, rotating it into other names. But remember, on the All In Pod, we have this phrase, let your winners run. So a key in this business is that you got to let the best companies continue to compound. You've heard me say it on this show before. A simple heuristic for the people watching at home. Think about managing your portfolio in 3 sizes: small, medium, and large. Okay? And when things are all washed out, when everybody's despondent like they were earlier this year over the start of the Iran war, maybe you take your portfolio to a large position. When everybody gets euphoric, you may want to take your portfolio from that large position to a medium-sized position. In my parlance, I call it 3-6-9, 30%, 60%, 90%. So, of course, when we see these types of moves, we take a little off the table that we can redeploy when we see volatility in the market. That's our job.
To what degree is Snowflake, to use the words that Kramer used this morning, coming after Databricks? The competitive angle now, what does that mean?
Well, make no mistake about it. These companies have been competitive from day one. They're run by incredibly competitive people. They do very similar things. But at the same time, this is one of the largest TAMs the world has ever known, intelligence. Every small, medium, and large business in the world is going to consume more tokens in the future, more intelligence in the future. So there's plenty big TAM for both of them to grow very quickly for a long period of time, but they're going to battle it out. I don't think it means that one's going to win and one's going to lose. And don't count out ClickHouse, which may be the fastest growing of the bunch. Which is also, one of our shareholdings. We fundamentally believe that data is the oil that runs the AI engine. And these are three of the most important companies in providing the data. So as more tokens are consumed, more data is consumed, and these companies are benefiting from that. And you see it in the results.
Hey, Brad, it's Josh Brown. If, let's say, a hypothetical CNBC viewer with $100,000 in cash for whatever reason, they want to put it into the market. They believe in the AI story. They believe it's secular and it's got years to go. How would you think about that if you were that viewer?
Today is not the day that you shove all in on the market. Go back to the heuristic I used, 369. And let's say you have zero in the market today and you want to put $100,000 to work. Then I would put 3. Right? I would put 30% of that to work because you have to start at some point and then you wait for your moments. Yes, we have incredible IPOs coming, starting with SpaceX, rumored on June 12th. Hopefully, I'll be back in the New York Stock Exchange with you guys. It's going to be an incredible IPO. It's going to raise about $75 billion. Okay, so if Altimeter, and we do want to buy the SpaceX IPO, I've got to raise that money from somewhere. So I've got to sell some other stocks in order to buy SpaceX. That's just the way it works. We don't have unlimited capital. And when Anthropic comes public in the fall, or OpenAI comes public in the fall, I'm going to have to sell something else to buy this. So your point is certainly correct. But the only thing I would say, Josh, is remember the depth of our capital markets. I mean, we're talking 100 trillion relative to $75 billion. So in the grand scheme of things, I think particularly because we're going to have early adoption, early inclusion in the index for SpaceX, I think there's going to be enough capital to do that.
Look, the one thing I'm thinking about with the inclusion of the indices, and Brad, I'd like your opinion on this, is the weighting in the indices, because they're going to have a market cap, SpaceX, $1.5 trillion, and yet at least with the triple Qs, they're talking about something like 3 times the float. Do you see any discrepancy in that? Does that lead to more upside if the float becomes bigger and they can add more to the indices? Just curious about your thoughts on that.
All I know is this: there's no human being on the planet that is better at turning electrons into tokens than Elon Musk, right? Let me say that again, because we focus a lot on the launch business. We focus a lot on the communications business, right, which is Starlink, which we all benefit from. But Elon is building the biggest data centers on Earth and eventually in space of anybody, and nobody is better at turning those electrons into tokens. That is an extraordinarily valuable place to sit. He just struck a huge deal with Anthropic. I think more deals are to come, and that, from my perspective, totally changed the game on the SpaceX IPO. I knew that the launch business was great. I knew that Starlink was great, but that alone would not justify the valuation. Him building the data centers which are going to power all of AI, and him then using those to train up his own AI with incredible team that he acquired from Cursor, I think is a total game changer for the IPO and puts them in a really good position.
What really stood out to me in this interview is how Brad keeps coming back to one core idea. AI is not just about chatbots anymore. It is becoming an entire economic ecosystem built around data, compute power, and token consumption. And according to him, the companies enabling that ecosystem are entering a completely different phase of growth. Right away, the conversation starts with Snowflake exploding higher after earnings. And honestly, Brad looked completely unsurprised by it. He basically says that weeks earlier he already expected data infrastructure companies like Snowflake, Databricks, and ClickHouse to have monster quarters because of what he calls token flow. And this is actually one of the most important concepts in the entire interview. What he means is simple. Every AI query, every AI image generation, every AI workflow, every AI agent, all of it consumes tokens. And as token usage rises globally, companies storing, organizing, processing, and delivering data are seeing massive acceleration in demand. In other words, the more AI gets used, the more these infrastructure businesses become essential. That is a huge distinction because a lot of investors are only focused on the flashy AI applications people interact with directly. But Brad is saying the real engine behind everything is data infrastructure. Without clean, accessible, organized data, these AI systems are useless. Personally, I think this is where a lot of retail investors are still underestimating the AI boom. Everyone is chasing the obvious names, but the companies selling the picks and shovels during a gold rush historically end up becoming some of the biggest long-term winners. And that is basically the lane Brad believes Snowflake and Databricks are sitting in right now. He also makes an interesting comparison between Snowflake and companies like Salesforce. He says Snowflake is different because it is not directly competing against AI model companies. Instead, it benefits from AI growth no matter which model wins. That is a very important point. Think about it this way. Whether OpenAI wins, Anthropic wins, Google wins, or some future company wins, they all still need enormous amounts of data infrastructure. So Snowflake becomes less of a bet on one AI model and more of a bet on the entire AI economy growing overall. And when Brad starts talking about the actual numbers from Snowflake's earnings, you can tell why Wall Street reacted so aggressively. He points out that the company delivered 33% growth when expectations were around 27%. That may not sound massive to regular people, but in Wall Street terms, that is a gigantic beat for a company at Snowflake's scale. Then he explains something else investors probably are not fully appreciating yet. Snowflake's AI products like Cortex and Snowflake Intelligence are finally hitting critical mass, meaning these are no longer just experimental products. Customers are actually adopting them in meaningful ways. That matters because Wall Street always pays a premium when it sees AI monetization moving from theory into reality. One thing I respected about Brad in this interview is that he did not pretend he made a perfect move with Snowflake. He openly admits they exited it from their public funds because they saw better opportunities elsewhere like Micron and ARM, which apparently were up around 200% year-to-date at the time. But at the same time, he still personally owns a massive Snowflake position, and honestly that tells you something important about professional investing. Great investors are not emotionally attached to stocks. They constantly compare opportunity costs. Even if they love a company long-term, they still move capital where they believe returns will be strongest in the near term. That part of the interview was actually one of my favorite moments because it shows the balancing act every investor faces. Sometimes you can be right about a company and still choose another investment because you think the upside is larger elsewhere. Then the discussion shifts into portfolio management, and I think this section was incredibly valuable for regular investors watching. Brad talks about letting your winners run, which is something easier said than done. Most people sell their winners too early because they get scared of losing gains. But Brad explains that the biggest returns often come from allowing elite companies to compound over years. At the same time, he also emphasizes risk management. He says when stocks become parabolic, meaning they rise too quickly, you trim exposure and rotate capital elsewhere. Not because the story is broken, but because portfolio management matters. I actually think this is where many retail investors struggle the most. People either become permanently bullish and refuse to take profits, or they panic sell during every pullback. Brad's framework tries to avoid both extremes. His 3-6-9 system was interesting too, basically adjusting exposure depending on market conditions. When fear dominates markets, you become more aggressive. When euphoria takes over, you scale back a bit and keep dry powder ready. And honestly, I think that is a smart mentality in this market right now because AI stocks have moved insanely fast. Even if the long-term trend remains bullish, that does not mean these stocks cannot experience brutal short-term corrections. Then the conversation moves into the competitive battle between Snowflake and Databricks. And Brad basically says this is not a winner-take-all market. That part really stood out to me because so many investors think every industry ends with one dominant company crushing everybody else. But Brad argues the AI data market is so enormous that multiple companies can win simultaneously. He says the total addressable market is one of the biggest the world has ever seen because every business on Earth is eventually going to consume more intelligence and more tokens. That is a bold statement, but honestly, it is hard to disagree with him when you think about where AI is heading. AI is not just entering tech companies, it is entering healthcare, finance, logistics, retail, manufacturing, education, entertainment, literally every sector imaginable, and every one of those industries will require massive data processing capabilities. I also found it interesting that Brad specifically mentioned ClickHouse alongside Snowflake and Databricks, because that tells you sophisticated investors are already looking beyond the obvious AI names. Sometimes the next massive winner is not even the company dominating headlines yet. Then the interview shifts into something that I think many investors are quietly worried about right now. The coming wave of gigantic AI IPOs. Josh Brown asks whether markets can actually absorb massive IPOs from companies like SpaceX, Anthropic, and OpenAI all around the same time. And this is where Brad becomes surprisingly cautious. He basically says today is not the day to go all in aggressively. That caught my attention because despite being extremely bullish on AI long-term, he still acknowledges markets can become overheated. That is something I personally agree with completely. You can believe in the future of AI while still recognizing valuations can temporarily run too far ahead of fundamentals. Brad says if someone had $100,000 ready to invest today, he would only put 30% to work initially, then wait for opportunities and volatility before deploying more capital. That is a very disciplined approach, especially during euphoric markets where everyone feels pressure to chase momentum. He also explains something many people forget. When giant IPOs come public, institutional investors often have to sell existing holdings to fund those purchases. Capital is not infinite, so when companies like SpaceX or OpenAI eventually hit public markets, there could absolutely be temporary pressure on other tech stocks as money rotates into these new opportunities. But Brad also balances that concern by reminding viewers how enormous U.S. capital markets are overall. In the grand scheme, even huge IPOs are still relatively small compared to total market liquidity. Then the conversation turns toward SpaceX, and honestly, this is where Brad's excitement level noticeably changes. You can tell he believes SpaceX is becoming something much larger than just a space company. He says most people focus on rockets and Starlink, but according to him, the real story is data centers and AI infrastructure. And this part was fascinating because Brad frames Elon Musk almost as an AI infrastructure operator rather than simply an automaker or aerospace entrepreneur. He says nobody is better at turning electrons into tokens than Elon Musk. That line alone probably summarizes Brad's entire AI thesis. Electricity powers data centers. Data centers power AI models. AI models generate tokens. And whoever controls that pipeline could become extraordinarily valuable. Brad believes Elon is building some of the largest data center infrastructure on Earth, and potentially even in space eventually. Whether people agree with Elon or not personally, you cannot deny he consistently thinks years ahead of where industries are moving. What also changed Brad's perspective, according to him, was Elon reportedly securing major AI-related partnerships and aggressively scaling infrastructure. He basically says SpaceX plus AI infrastructure plus data center dominance creates an entirely different valuation story than simply being a launch company. And honestly, I think this is where markets are heading overall. Investors are increasingly rewarding companies positioned at the intersection of AI, compute, energy, and data infrastructure because all four are becoming deeply interconnected. That is why companies involved in semiconductors, cloud infrastructure, energy grids, cooling systems, and networking are suddenly becoming some of the hottest investments on the planet. What this interview really reinforced for me is that we are probably still in the early innings of the AI capital cycle. But at the same time, Brad makes it very clear that investors need discipline. He is bullish, but not blindly bullish. He believes AI remains the strongest secular trend in the market, but he also expects volatility, consolidations, and pullbacks along the way. And honestly, that may be the healthiest takeaway from this entire conversation. You do not need to choose between permanent fear and reckless euphoria. You can stay optimistic long-term while still managing risk intelligently. Because if Brad Gerstner is right, the next decade is going to be defined by companies controlling data, compute power, token generation, and AI infrastructure. And the competition between Snowflake, Databricks, OpenAI, Anthropic, SpaceX, and others may end up reshaping the entire global economy. Now let's dive in and talk about the 3 exceptional AI stocks that could create enormous long-term wealth as artificial intelligence reshapes the global economy over the next decade. Let's start with the first stock. Advanced Micro Devices, ticker symbol AMD, has transformed itself from a struggling semiconductor company into one of the most important players in artificial intelligence and high-performance computing. And what makes AMD so interesting right now is that the market may still be underestimating how large the opportunity ahead could become. Most people know AMD for gaming chips and PCs, but the company today is operating in something much bigger. AMD is becoming one of the central infrastructure providers for the AI era. As companies race to build larger AI models, process more data, and expand cloud computing capacity, the demand for powerful chips continues exploding. And AMD is positioning itself to capture a meaningful piece of that market. The reason this matters is because AI is not just software. Every AI model requires massive computational power behind the scenes. Training AI systems takes enormous processing capability, advanced accelerators, energy-efficient architecture, and scalable data center solutions. Without chips, AI simply does not exist, and this is exactly where AMD enters the picture. Over the last several years, AMD has aggressively expanded its data center business, and this segment is quickly becoming one of the most important growth engines for the company. Its Instinct AI accelerators are gaining traction as enterprises and cloud providers look for alternatives in the AI hardware market. What makes this opportunity so compelling is that the AI chip market itself could become one of the largest technology markets in history. We are talking about hundreds of billions of dollars potentially flowing into AI infrastructure over time. Companies across industries are spending aggressively to secure computing power because they know falling behind in AI could become an existential threat. AMD understands this perfectly. The company has spent years improving its architecture, execution, and product competitiveness. And today, the company is no longer viewed as an underdog in semiconductors. It is viewed as a legitimate high-performance computing powerhouse. One thing I personally find impressive about AMD is how disciplined management has been in positioning the business for long-term growth rather than short-term hype. They are not simply chasing headlines. They are building ecosystems around AI acceleration, enterprise data centers, cloud computing, and adaptive computing solutions. That matters because sustainable winners in AI are likely going to be businesses deeply integrated into the infrastructure layer of the economy. Another major strength AMD has is diversification. While AI gets the attention, the company also maintains strong exposure to gaming, embedded systems, enterprise computing, and cloud infrastructure. This creates multiple pathways for growth rather than relying entirely on one trend. And when you look at the broader semiconductor landscape, one thing becomes clear. Demand for compute power is accelerating faster than most analysts expected just a few years ago. AI models are becoming larger. Enterprise workloads are becoming more complex. Data centers are expanding rapidly, and businesses are increasingly prioritizing AI integration into their operations. All of this drives greater demand for advanced chips. AMD's data center segment has become especially important because this is where some of the highest margin and fastest growing opportunities exist. Data centers are essentially the backbone of AI deployment, and cloud providers are spending billions upgrading infrastructure to meet surging demand. AMD is benefiting directly from that trend. The company has also benefited from its acquisition strategy, particularly with adaptive computing capabilities that strengthen its position in AI and embedded systems. These moves give AMD broader exposure to markets expected to grow significantly over the next decade. And when investors evaluate long-term compounders, one of the most important things to watch is whether a company is becoming more strategically relevant over time. AMD clearly is. 5 years ago, many investors primarily associated AMD with CPUs and gaming. Today, the company is increasingly associated with AI infrastructure, enterprise computing, and data center acceleration. That evolution is incredibly important because markets tend to reward companies that move up the value chain. Financially, AMD has also demonstrated impressive momentum. Revenue growth in key segments has accelerated as AI-related demand strengthens, and the company has continued improving profitability while investing heavily into future growth opportunities. Its balance sheet position has also improved substantially compared to where the business stood years ago, giving AMD more flexibility to continue investing aggressively in innovation and expansion. Another thing investors should pay attention to is the secular nature of this trend. AI is not a one-year story. It is not a 2-year story. This is potentially a decade-long infrastructure build-out similar to what happened during the rise of cloud computing and the internet itself. And when you are investing in long-term winners, you want companies positioned at the center of those secular transformations. AMD appears to fit that profile. One of the biggest reasons many investors remain bullish on AMD is because the company still may have room to gain market share in high-performance computing and AI acceleration markets. As enterprises seek more options and flexibility in AI infrastructure spending, AMD could continue expanding its footprint. And from an investing perspective, this creates a very interesting dynamic. You have a company operating in one of the fastest-growing industries on Earth, with improving execution, rising relevance, expanding data center exposure, and significant long-term AI catalysts. That combination is extremely powerful. What also makes AMD compelling is the scale of AI demand now emerging globally. Governments, corporations, startups, and cloud providers are all racing to build AI capabilities simultaneously. This is creating a massive spending cycle on chips, networking infrastructure, and computing power. In many ways, we are witnessing the early stages of a global AI arms race, and companies supplying the infrastructure behind that race could become some of the biggest winners of the next decade. Another thing I think long-term investors should appreciate is AMD's ability to adapt and evolve. Technology changes fast. The companies that survive long-term are usually the ones capable of reinventing themselves as industries evolve. AMD has already demonstrated that capability. The company went from near irrelevance years ago to becoming a serious force in semiconductors and AI infrastructure. That type of turnaround does not happen by accident. It requires execution, vision, and strong leadership. Now, of course, no investment is risk-free. Semiconductor stocks can be volatile. Competition remains intense. AI spending cycles could fluctuate over time, and valuation expectations can sometimes become aggressive during periods of market optimism. But when evaluating long-term investments, sometimes the most important question is simple. Will this business likely be more important to the global economy 10 years from now than it is today? For AMD, there is a very strong argument that the answer is yes, because if AI adoption continues accelerating globally, the world will need more compute power, more advanced semiconductors, more scalable infrastructure, and more efficient AI acceleration, and AMD is positioning itself directly in the middle of that opportunity. This is why many long-term investors continue viewing AMD as one of the most compelling AI infrastructure plays in the market today, not because it is a speculative trade, not because it is the hottest stock this week, but because the underlying business is becoming increasingly critical to one of the largest technological shifts of our generation. And honestly, I think we are still early in understanding how massive AI infrastructure demand could ultimately become. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second exceptional AI stock to consider for the long term is Lam Research, ticker symbol LRCX. And this is where things start getting really interesting because Lam Research is not the type of AI stock most retail investors talk about every day. It is not a flashy consumer-facing company. It is not constantly dominating social media headlines. But behind the scenes, this business plays a critical role in the entire semiconductor ecosystem powering artificial intelligence. In fact, without companies like Lam Research, the advanced AI chips driving the AI revolution simply could not be manufactured at scale. That is what makes this business so important. Lam Research specializes in semiconductor manufacturing equipment. In simple terms, the company builds the highly advanced machinery used to produce cutting-edge chips. These systems are incredibly complex, extremely expensive, and absolutely essential for chipmakers pushing towards smaller, faster, and more powerful semiconductors. And as AI demand explodes globally, the need for more advanced chip production also rises dramatically. This creates a massive long-term opportunity for Lam Research. One thing I think many investors fail to fully appreciate is that AI is not just creating demand for software and cloud services. It is creating an enormous industrial build-out underneath the surface. Entire supply chains are expanding to support AI infrastructure, and semiconductor manufacturing sits directly at the center of that expansion. Every AI server requires advanced chips. Every data center requires advanced chips. Every enterprise AI workload depends on advanced chips. And manufacturing those chips requires sophisticated equipment from companies like Lam Research. That gives Lam Research an incredibly valuable position in the semiconductor ecosystem. The company operates in an industry with very high barriers to entry. Developing advanced semiconductor manufacturing equipment is not something competitors can easily replicate overnight. These machines require decades of engineering expertise, deep customer relationships, and constant innovation. That creates a strong, and now AI is accelerating that investment cycle even further. One of the biggest themes driving Lam Research right now is advanced memory demand. AI workloads consume massive amounts of memory and data processing capacity. As AI models become larger and more sophisticated, the need for high-bandwidth memory and advanced storage solutions increases significantly. This directly benefits semiconductor manufacturing equipment companies because producing next-generation memory chips requires increasingly advanced fabrication technology. Lam Research plays a key role in enabling that production. Financially, the company has also demonstrated strong resilience through different market cycles. Semiconductor industries can experience volatility, but Lam Research has consistently maintained strong profitability, robust free cash flow generation, and shareholder returns. The company has historically returned substantial capital to shareholders through dividends and stock buybacks while continuing to invest aggressively in research and development. That balance is important. Some companies sacrifice long-term innovation for short-term profits. Others invest heavily, but fail to generate strong cash flow. Lam Research has managed to execute both relatively well, and that combination can become incredibly valuable over time. One thing I personally like about this business is that it benefits from AI growth regardless of which specific AI model or software platform ultimately dominates the market. Whether enterprises build their AI systems around one architecture or another, they still need advanced semiconductors. And advanced semiconductors still require sophisticated manufacturing equipment. That creates a very durable investment thesis. It is similar to investing in the infrastructure behind a gold rush instead of trying to predict which individual miner will strike the most gold. As AI competition intensifies globally, semiconductor complexity is increasing rapidly. Chip makers are pushing toward more advanced packaging technologies, higher transistor density, and greater energy efficiency. All of these trends increase the importance of manufacturing precision, and that is exactly where Lam Research specializes. Another thing investors should pay attention to is the sheer scale of long-term semiconductor demand likely coming over the next decade. Artificial intelligence is only one piece of the puzzle. Cloud computing continues expanding, data center demand keeps growing, industrial automation is accelerating, high-performance computing workloads are increasing, digital infrastructure continues scaling globally. All of these trends require more semiconductors, and more semiconductors require more manufacturing equipment. This is why companies like Lam Research can quietly compound for years without necessarily receiving the same public attention as more consumer-visible technology companies. What makes this particularly attractive for long-term investors is that semiconductor manufacturing itself has become one of the most strategically important industries in the global economy. Countries understand this. Corporations understand this. Investors are increasingly understanding this too. Control over semiconductor production capabilities increasingly influences economic competitiveness, national security, and technological leadership, and businesses enabling semiconductor advancement could remain critically important for decades. Lam Research also benefits from deep technical integration with customers. Once equipment becomes embedded into manufacturing processes, switching providers is not always simple or cost-effective. That strengthens customer retention and reinforces competitive advantages. And when evaluating long-term compounders, sticky customer relationships are extremely valuable. One thing I think investors sometimes overlook is that AI growth actually increases pressure on semiconductor manufacturing efficiency. As AI workloads scale globally, chip demand can surge rapidly. Manufacturers must improve throughput, yields, and production capabilities to keep up. That means companies enabling manufacturing optimization may become even more valuable over time. Lam Research sits directly within that trend. Now, of course, semiconductor industries are cyclical. There will likely be periods where chip demand softens temporarily. Capital expenditures may fluctuate. Macroeconomic conditions can impact spending cycles. But secular trends often matter more than temporary cycles for long-term investors. And the secular demand for semiconductors appears extremely strong moving forward. AI infrastructure expansion alone could drive enormous long-term semiconductor investment globally. Another thing worth mentioning is how rapidly AI models are evolving. Training larger and more sophisticated models requires exponentially more compute power. That increases demand for advanced fabrication technologies capable of producing increasingly powerful chips efficiently. This creates a long runway for semiconductor equipment providers. And while many investors focus primarily on AI software companies, some of the most durable long-term returns may actually come from infrastructure businesses quietly enabling the entire ecosystem behind the scenes. That is exactly why Lam Research deserves serious attention. It is not simply riding AI hype, it is supplying critical tools needed to build the future of computing itself. And when you own companies deeply embedded into foundational infrastructure trends, the compounding effects over time can become extraordinary. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third exceptional AI stock to buy for the long term is Microsoft, ticker symbol MSFT. And honestly, when you look at the AI landscape today, it becomes very difficult to ignore just how powerful Microsoft's position has become. This is no longer just a software company selling operating systems and productivity tools. Microsoft is rapidly transforming itself into one of the central pillars of the entire artificial intelligence economy. And what makes Microsoft so dangerous from a competitive standpoint is that the company is not approaching AI from just one angle. It is embedding AI across cloud infrastructure, enterprise software, productivity applications, cybersecurity, search, developer tools, and business operations simultaneously. That level of integration creates an ecosystem advantage very few companies on Earth can replicate. One thing I think investors need to understand is that Microsoft already had one of the strongest business moats in the world before the AI boom even started. Billions of people already use Microsoft products. Businesses already depend on Microsoft infrastructure. Enterprises already operate critical workloads on Microsoft systems. And now AI is being layered directly into that existing ecosystem. That is incredibly powerful. Because instead of trying to convince customers to adopt an entirely new platform, Microsoft can simply enhance products businesses are already deeply dependent on. This dramatically lowers friction for AI adoption. And in many ways, that may become one of Microsoft's greatest advantages over the long term. Take cloud computing, for example. Microsoft Azure has become one of the most important cloud platforms globally, and AI demand is now accelerating cloud spending even further. Businesses deploying AI tools need computing power, storage, security, networking infrastructure, and scalable cloud services. Azure benefits directly from all of that. And as AI workloads grow larger, enterprises are likely going to spend even more on cloud infrastructure over time. That creates a major long-term growth engine for Microsoft. Another thing that makes Microsoft unique is its deep integration into enterprise environments. Large organizations often move slowly when adopting new technologies because reliability, security, and compatibility matter enormously. Microsoft already has trusted relationships with enterprise customers worldwide. That trust becomes extremely valuable during major technological transitions like AI adoption. When businesses evaluate AI solutions, many would rather work with an established partner already embedded into their operations, rather than take unnecessary risks with unproven platforms. Microsoft understands this perfectly. The company is positioning itself as the safe and scalable enterprise AI leader. And honestly, I think that strategy could pay off massively over the next decade. Another major strength is Microsoft's recurring revenue model. This is one of the reasons long-term investors love businesses like this. Subscription-based revenue creates predictable cash flow, customer retention, and operating leverage. As Microsoft integrates AI features into existing subscription products, the company gains opportunities to increase monetization while strengthening customer dependency. That combination is extremely attractive from an investing perspective. Now let's talk about productivity software, because this could become one of the most important AI monetization opportunities in the world. Millions of businesses rely on Microsoft tools every single day for communication, spreadsheets, presentations, workflow management, and collaboration. Imagine AI deeply integrated across all of those workflows: automated document generation, AI-powered business analysis, workflow optimization, intelligent meeting summaries, AI-assisted coding, enterprise automation. These capabilities can dramatically improve productivity for businesses globally, and when software directly improves efficiency and saves time, companies are often willing to pay for it. That creates enormous monetization potential. One thing I personally think makes Microsoft particularly attractive long-term is the sheer breadth of its AI exposure. Some companies are dependent on one AI product succeeding. Microsoft benefits from AI adoption across multiple segments simultaneously: cloud growth, enterprise AI tools, developer ecosystems, cybersecurity, search, business productivity, data infrastructure. This diversification creates resilience, and resilience matters enormously when investing for the long term. Financially, Microsoft also remains one of the strongest companies in the world. The business generates massive free cash flow, maintains exceptional profitability, and possesses one of the strongest balance sheets in corporate America. That financial strength allows Microsoft to invest aggressively into AI infrastructure while still returning capital to shareholders. And scale matters more than ever in AI. Building large-scale AI infrastructure requires enormous amounts of capital. Data centers, chips, networking equipment, cooling systems, and cloud architecture all require massive investment. Not every company can afford that. Microsoft can. And because Microsoft already operates at enormous scale, the company may actually strengthen its competitive position as AI infrastructure requirements become more expensive. Another thing I think investors underestimate is how much AI demand could increase overall software consumption. Historically, major technology shifts tend to expand markets rather than simply replace existing products. AI may allow businesses to accomplish things previously impossible or too expensive. That could unlock entirely new categories of enterprise spending, and because Microsoft already sits at the center of enterprise software infrastructure, the company could capture a substantial portion of that growth. What also stands out about Microsoft is management execution. The company has consistently adapted across multiple technological eras: personal computing, enterprise software, cloud computing, and now artificial intelligence. That ability to evolve matters enormously for long-term investors. Technology changes rapidly. The companies capable of staying relevant across multiple industry shifts often become some of the greatest compounders in history. Microsoft has already proven it can do that. Now, of course, there are risks. Competition in AI remains intense. Infrastructure spending requirements are massive. Regulatory scrutiny could increase over time. And expectations surrounding AI monetization are becoming very high. But even with those risks, Microsoft's combination of scale, infrastructure, enterprise relationships, recurring revenue, and financial strength gives it one of the most compelling long-term AI positions in the market. And honestly, what makes Microsoft especially attractive is that investors are not betting on a single AI product succeeding. They are betting on one of the largest technology ecosystems on Earth, integrating AI into products and services already used globally at enormous scale. That is a very different type of investment thesis. When you step back and look at the bigger picture, all three companies we discussed today operate in different but equally critical layers of the AI economy. Advanced Micro Devices is helping power the compute infrastructure behind AI. Lam Research is enabling the manufacturing of the advanced semiconductors needed for AI expansion. And Microsoft is embedding AI directly into global enterprise software and cloud ecosystems. That creates three very different pathways to potentially benefit from long-term AI growth. And personally, I think that is one of the smartest ways to approach AI investing right now. Not by chasing hype, not by gambling on speculative trends, but by focusing on businesses with durable competitive advantages, strong balance sheets, real cash flows, and critical positions inside the AI ecosystem. Because while AI headlines may fluctuate over time, the long-term infrastructure build-out behind artificial intelligence could continue for many years. And companies deeply embedded into that infrastructure may ultimately become some of the biggest winners of the next decade. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage in the AI race, and which one would you feel most comfortable holding for the next decade? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.